Hello, Avila Advantage Money and Banking students. We are now in week 4 and we're approaching the halfway point of the course. This week is a little bit lighter week, so there's no forum discussion, but you will have to read chapter 11 and complete the exam. The exam has a total of 45 questions, I believe. They're multiple choice, and the exam will be available Wednesday, and you will have 4 hours to complete the exam. So just make sure that you can take the exam in a time period without interruption, and just get that done by Sunday before midnight. So again, with this week we only have one chapter, chapter 11. It discusses kind of that issue that financial institutions have, and also from an individual, that they're trying to figure out how to reduce information cost or transaction cost, because in the world of banking, essentially we call it asset liability management, the bank's assets are the loans that they make. Their liabilities are actually your deposits. So especially in the realm of lending out money, or if it's in the private sector or the corporate sector, making sure that an officer is doing their job, there has to be some monitoring. And banks are in the business of trying to reduce transaction cost. That's the benefit they have. They try to gather as much information as they can about individuals to determine risk. And the textbook points out right away about this issue of asymmetric information, that one party is going to know more information than the other. If you take out a loan, you know more likely what you're going to do with the money, how you're going to determine whether you're going to keep working or not, or decide just I'm going to take the money and go on vacation and have fun, and I don't have any intentions of planning to pay it back. But banks use various things like FICO scores, what we call credit scores. They look at your characteristics and your past payment history to say, hey, is this person a good risk? But those risks always exist, and things can change too. Somebody could lose their job, the economy can change. I was talking to a banker over the weekend at a family reunion. I was asking him, what his portfolio consisted of in this small town of Marshall, Missouri, and he said his was mostly, residential and car loans. Occasionally they do some business with some farmers, but that was kind of the sweet spot of their business in a local community, and they did well with that. But again, getting back to some of the concepts in this week's reading, when they talk about the idea of adverse selection and moral hazard, adverse selection, or we're trying to figure out in terms of what are good risks, what are bad risks, but more importantly, moral hazard is that, let's say that I have health insurance, maybe I take on more risk, such as skydiving or smoking, because I know that I'm covered. Well, banks have to discern between what type of risk they can take on and try to assess individuals or corporations or businesses when they make loans. So, and there's also a lot of institutions out there, like the SEC does a good job of having, at least in the equity sector or the stock sector, having to disclose information to investors so they understand the risk that they're taking on. And even with in terms of other things such as corporations or any business, we discuss what's called the principal agent theory. Principal holders are like the stockholders. Agents are the managers or the leaders of companies. And a lot of times we try to put things in place or incentives in place to make sure that they are doing the right things. I think one of your homework questions, you'll kind of read into that and let you think about a little bit more about the principal agent problem. But one more thing, a couple other things this week with this chapter, also with debt financing, corporations, debt, they're reviewed by S&P, Moody's. They pay to have these things reviewed. They discuss the concept of the free rider problem, that many of us can get information about these companies through the work of others. But in order to issue debt or issue equity, they do have to be evaluated by outside sources so people can assess the risk. And a lot of times in debt agreements, there are loan covenants that restrict certain things about what the company can do or the business can do. So if things go bad, they just can't go to Vegas and bet on black. And hopefully, the things go in their favor. So they're going to put restrictions if things do go bad, that they stick to the best practices and ensure some type of repayment, not guarantee, but help the creditors in trying to get some of their money back. So Well, that's it for this week, but a little bit lighter week. But again, maybe towards the weekend, jump in there and get your exam done, get the homework submitted, and otherwise have a great week, and we'll talk to you later. Take care.